In 1929, the stock market crashed and America entered the Great Depression. Stocks fell 89% over 3 years, 25% unemployment, banks failed, savings wiped out. It took 25 years for the market to recover to 1929 levels. In 2008, the housing market crashed and triggered the Great Recession. Stocks fell 57% in 18 months, 10% unemployment, banks needed bailouts, retirement accounts devastated. It took 5 years for markets to recover, but 2025 is different. This time stocks, bonds, and real estate are all crashing simultaneously in what financial historians are calling the everything bubble. And when everything crashes together, there's nowhere to hide. What if I told you we're not in a new situation? We're in 1928, right before the Great Depression. Except this time, it's worse because the tools that saved us after 1929 and 2008 no longer exist. The Federal Reserve can't cut interest rates to zero because they're already low. They can't print unlimited money because they just did that and caused the worst inflation in 40 years. The government can't bail everyone out because it's already drowning in $36 trillion of debt. Let me show you why every major financial indicator is flashing red, why the crash window is November 2025 to June 2026, and why the coming collapse will destroy more wealth than any event in human history. This isn't speculation, this is mathematics. To understand why 2025 is different from every previous crash, you need to understand that we're not in one bubble. We're in 3 simultaneous bubbles that have never occurred together in financial history. Start with the stock market. The S&P 500 is trading at a price-to-earnings ratio of 28, nearly double the historical average of 15 to 17. This level of overvaluation has only occurred twice before. In 1929, right before the Great Depression, and in 2000, right before the dot-com crash that destroyed 78% of the Nasdaq's value. Both times, the market crashed within months of hitting these extremes. But the concentration risk in 2025 makes the situation even more dangerous than 1929 or 2007 stocks. Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla represent approximately 30% of the entire S&P 500's total market value. This means that if these 7 companies crash, they take the entire market down with them. This concentration hasn't existed since 1929, when a handful of industrial stocks held up the entire market right before the collapse. In 2000, the dot-com bubble was concentrated in technology stocks, but they represented a smaller percentage of the overall market. Today's concentration is more extreme, more dangerous, and more fragile. Nvidia alone illustrates the insanity of current valuations. The company trades at a price-to-earnings ratio above 65, meaning investors are paying $65 for every dollar of profit the company generates. Nvidia's total market value exceeds $3 trillion, making it worth more than the entire German stock market, the 4th largest economy in the world. This isn't rational valuation. This is speculation driven by artificial intelligence hype that mirrors the internet hype of 1999. Everyone believes AI will change everything, just like everyone believed the internet would change everything in 1999. They were right about the internet's long-term impact. They were catastrophically wrong about short-term stock valuations. The same thing is happening now with it. The second bubble is real estate, and it's actually more overvalued than the 2008 housing bubble that destroyed the global financial system. In November 2025, home prices are approximately 50% above their long-term historical trend relative to income and rent. At the peak of the 2008 bubble, homes were 35% above trend. This means the current housing bubble is 43% larger than the bubble that caused the Great Recession. Let that sink in. The crisis that required trillions in bailouts and nearly destroyed capitalism was 35% overvaluation. We're now at 50% overvaluation, and most people don't even realize we're in a bubble because prices have been high for so long that it feels normal. But residential real estate is only part of the story. Commercial real estate is in freefall, creating a slow-motion crisis that will accelerate through 2025 and 2026. Office buildings across America sit 45% vacant as remote work becomes permanent. San Francisco has a 35% vacancy rate in commercial office space. These buildings were financed with mortgages when interest rates were 3%. Now those mortgages are coming due and need to be refinanced at 7 to 9% interest rates. The buildings aren't worth enough to support the new debt service at triple the interest rate. This means defaults, bank losses, and a cascade of failures that will mirror the 2008 subprime crisis, except in commercial properties instead of residential. The third bubble, and this is what makes 2025 unprecedented, is the bond market. Government bonds are supposed to be the safe asset you hold when stocks crash. In 1929, bonds were safe even as stocks collapsed 89%. In 2008, Treasury bonds rallied as investors fled stocks for safety. But in 2025, bonds are crashing alongside stocks because the US government has issued so much debt that the bond market can't absorb it anymore. Total federal debt exceeds $36 trillion, approximately 125% of GDP. This is the same debt to GDP ratio America had at the end of World War II. Except afterwards, America was the only major economy not destroyed by war. Today, America is competing with countries that have lower debt and stronger fundamentals. The annual interest payment on this debt now exceeds $1.2 trillion per year, making it the single largest line item in the federal budget, larger than defense spending, larger than Social Security. When interest payments exceed everything else, the government has three choices: cut spending drastically and cause a recession, raise taxes drastically and cause a recession, or print money to pay the debt and cause inflation. All three options lead to economic crisis. There's no good path forward when your interest payments alone equal the GDP of Mexico. This is the everything bubble. Stocks overvalued at levels only seen twice before, both times before crashes. Real estate more overvalued than 2008, and bonds, the traditional safe haven, crashing under the weight of unpayable government debt. The parallels between 2025 and 1929 are so precise that it's like watching history repeat itself frame by frame. In 1929, stock valuations reached extremes that had never been seen before. The price-to-earnings ratio of the Dow Jones Industrial Average hit 33, far above any historical precedent. In 2025, we're at similar levels, with the S&P 500 trading at 28 times earnings. The public in 1929 believed that new technology, specifically electricity, the radio, and the automobile, had created a permanent new economy where old valuation rules no longer applied. "This time is different" was the phrase repeated constantly in 1929. In 2025, artificial intelligence is the new technology that supposedly makes old rules obsolete. In 1929, margin debt, money borrowed to buy stocks, reached record levels as everyone from doctors to shoeshine boys leveraged themselves to participate in the boom. Stories circulated about ordinary people becoming rich overnight through stock speculation. In 2025, margin debt as a percentage of GDP is at similar extremes, but modern leverage extends beyond traditional margin accounts. Options trading by retail investors has exploded. People are using credit cards to buy stocks. Companies are borrowing money to buy back their own shares at inflated prices. The leverage in the system is everywhere, hidden in derivatives, options, and debt structures that most people don't understand. Wealth inequality in 1929 had reached extremes where the top 1% controlled approximately 25% of total income. This concentration meant that the economy depended on a small number of wealthy individuals continuing to spend and invest. When they stopped, the entire system collapsed. In 2025, wealth inequality has reached even higher levels. The top 1% controls approximately 32% of total wealth, higher than 1929. The economy depends on the top 10% who controls 70% of consumer spending. If the wealthy stop spending because their stock portfolios crash, consumer demand disappears, and the economy collapses. But here's where 2025 is actually worse than 1929. In 1929, most Americans weren't in the stock market. Only about 10% of households owned stocks, which means 90% of the population wasn't directly affected by the stock crash. They suffered later through unemployment and deflation. But the initial crash didn't wipe out their savings because they didn't have savings in stocks. In 2025, approximately 58% of American households own stocks either directly or through retirement accounts like 401 kiloseconds and IAs. This means that when the market crashes, it directly destroys the retirement savings of more than half the country. There's no insulation, no buffer. Everyone suffers immediately. The banking sector in 1929 was fragmented across thousands of small banks with no federal insurance. When the crash came, banks failed because depositors panicked and withdrew their money. The lack of deposit insurance meant that bank failures wiped out ordinary people's savings. In 2025, we have FDIC insurance that supposedly protects deposits up to $250,000. But the FDIC has only about $125 billion in its fund, while insuring approximately $10 trillion in deposits. If multiple large banks fail simultaneously, the FDIC fund is laughably insufficient. The government would have to print trillions to make depositors whole, which would destroy the currency through inflation. Either depositors lose their money through bank failures or they lose their money through inflation. Pick your poison. The Federal Reserve in 1929 had credibility and room to act. They'd only been established in 1913, 16 years earlier, and hadn't yet destroyed public confidence through decades of boom-bust cycles. They could have cut interest rates more aggressively, but didn't understand what they needed to do until it was too late. In 2025, the Federal Reserve has spent the last 15 years proving it can't manage the economy. They inflated a massive bubble through quantitative easing after 2008. They kept rates too low for too long, creating the everything bubble. Then they raised rates too aggressively in 2022 and 2023, causing inflation while simultaneously threatening to crash the economy. The Fed has lost credibility. More importantly, they've lost the tools to fix the next crisis. The 2008 financial crisis provides an even more recent and relevant comparison to what's coming in 2025 and 2026. In 2008, the crisis began with subprime mortgages, loans to people who couldn't afford them that were then packaged into complex securities and sold to investors worldwide. When housing prices stopped rising, borrowers couldn't refinance and started defaulting. The defaults cascaded through the financial system, revealing that banks were massively overleveraged and holding worthless mortgage-backed securities. In 2025, subprime lending exists everywhere, except we don't call it subprime. Auto loans with 84-month terms at high interest rates to people with poor credit. Credit card debt at record levels with average interest rates exceeding 21%. Student loans totaling $1.77 trillion that will never be fully repaid. Corporate debt that quintupled from $2 trillion in 2008 to over $10 trillion today, as companies borrowed at low rates to buy back stock. The leverage in the system in 2008 was primarily concentrated in housing and mortgage-backed securities. Banks like Lehman Brothers were leveraged 30-to-1, meaning they had $30 of assets for every $1 of capital. When those assets declined even 3%, the bank was wiped out. Lehman collapsed in September 2008, triggering the worst financial panic since the Great Depression in 2025. Leverage isn't concentrated in one sector, it's everywhere. The derivatives market now exceeds $600 trillion in notional value, 10 times global GDP. Most of these derivatives are interest rate swaps and credit default swaps that would explode if either interest rates move dramatically or if major corporate defaults begin. The interconnection means one failure triggers others, which trigger others in a cascade that can't be stopped. In 2008, the Federal Reserve had powerful tools to address the crisis. Interest rates were 25% when the crisis began, giving the Fed room to cut all the way to zero. This stimulated borrowing and spending, helping to stabilize the economy. The Fed could also implement quantitative easing, buying trillions in treasury bonds and mortgage-backed securities to inject money into the financial system. The Fed's balance sheet went from $800 billion before the crisis to $4 trillion by 2014. This unprecedented money printing helped avoid a complete collapse, but created the bubbles we're dealing with now. In 2025, interest rates are already relatively low, giving the Fed minimal room to cut. If they cut rates dramatically, they risk reigniting inflation that just required painful rate hikes to bring under control. If they don't cut, they let the economy crash into depression. Quantitative easing is similarly constrained in 2025. The Fed's balance sheet is already over $7 trillion after multiple rounds of QE following 2008 and then again during QE. They can print more money, but everyone now understands that printing money causes inflation. The 2021 to 2023 inflation surge, the worst in 40 years, proved that you can't print unlimited amounts without destroying the currency's purchasing power. The Fed is trapped. Print money and destroy the dollar through inflation. Don't print and let deflation create another Great Depression. There's no good option because the tools that worked in 2008 don't work anymore after being overused. The government bailout capacity is also exhausted. In 2008, the government could borrow to bail out banks because federal debt was about 67% of GDP, manageable by historical standards. The Troubled Asset Relief Program (TARP) authorized $700 billion to buy toxic assets from banks. Additional programs brought the total bailout close to $2 trillion. This was politically unpopular but economically feasible because the government had borrowing capacity. In 2025, federal debt is 125% of GDP with trillion-dollar deficits. As far as the eye can see, the government doesn't have another $2 trillion to bail out failing banks and corporations. If they try to borrow it, bond markets will revolt and interest rates will spike even higher, making the debt service even more unsustainable. The bailout option that saved the system in 2008 doesn't exist in 2025. The international dimension makes 2025 worse than 2008 as well. In 2008, China was booming and helped pull the global economy out of recession by stimulating domestic demand and buying commodities. Europe, while affected by the crisis, wasn't in the same debt trap as the United States. Global cooperation through the G20 coordinated stimulus efforts. In 2025, China is experiencing its own economic crisis with a collapsing real estate sector, local government debt exceeding $13 trillion, and a demographic crisis as the population shrinks. Europe is dealing with energy crisis, demographic decline, and political fragmentation. There's no major economy in position to lead global recovery. Geopolitical tensions mean cooperation is unlikely. When the crisis hits, every country will be fighting for survival rather than coordinating solutions. The most reliable predictor of recessions over the last 70 years has been the inverted yield curve, when short-term interest rates exceed long-term rates. This has predicted every recession since 1950 with no false positives. The yield curve inverted in July 2022 and remained inverted for 27 months, finally normalizing in September 2024. Historical analysis shows that recessions typically begin 3 to 12 months after the yield curve returns to normal, not while it's inverted. This means the danger window is October 2024 through September 2025. We're in that window right now. The signal that has never been wrong is telling us the recession is imminent. Consumer debt has reached levels that make the 2008 crisis look manageable by comparison. Credit card debt exceeds $1.14 trillion, an all-time record in nominal terms. The average credit card balance is $6,800 per household, with interest rates averaging 21 to 28%. Credit card delinquencies, the percentage of borrowers 90 days or more behind on payments, have risen to levels not seen since 2011. This matters because consumer spending represents 68% of the US economy. When consumers can't borrow anymore and have to start paying down debt instead of spending, the economy contracts. We're at the point where consumers are maxed out. They can't keep the spending going that the economy requires. The commercial real estate crisis is unfolding in slow motion, but will accelerate dramatically through 2025 and 2026. Over $2 trillion in commercial mortgages come due during this period and must be refinanced. These properties were financed when interest rates were 3%. Today's rates are 7 to 9%. A building that barely cash flowed at 3% interest is bankrupt at 8% interest. The math doesn't work. Building values have dropped 40 to 60%. In many markets because buyers understand the properties can't support the debt at current rates. When these mortgages can't be refinanced, the owners will default and hand the keys to the lender. Regional banks holding these mortgages will realize massive losses that wipe out their capital. Regional bank failures in 2023 were a warning that few people heeded. Silicon Valley Bank collapsed in March 2023 in the second largest bank failure in US history. Signature Bank failed the same week. First Republic Bank failed in May 2023 and was absorbed by JP Morgan at a massive loss covered by the FDIC. New York Community Bank teetered on the edge of collapse in January 2024. These failures occurred even though we weren't in a recession. When the recession hits and loan defaults surge, dozens more regional banks will fail. The FDIC will run through its $125 billion insurance fund within weeks. The government will have to print money to cover deposits, destroying the currency's value. The concentration of market value in 7 stocks, the so-called Magnificent Seven, creates fragility that didn't exist in previous eras. Apple, Microsoft, Nvidia, Amazon, Google, parent Alphabet, Meta, and Tesla represent 30% of the S&P 500's total market capitalization. Nvidia alone, with its price-to-earnings ratio above 65, accounts for approximately 7% of the entire index. If Nvidia's earnings disappoint or if AI hype fades, the stock could easily drop 50 to 70%. That single stock declining would take the entire market down with it. This concentration risk is unprecedented. When the market crashes, these 7 stocks will lead the decline, and because they're such a large percentage of the index, the crash will be faster and more severe than anything we've seen. Insider selling has reached levels that historically precede major market declines. Corporate executives have access to information that ordinary investors don't. They see the real earnings, the real pipeline, the real problems before anyone else when they start selling massive amounts of their own company's stock. It's a signal that they don't believe current prices are sustainable. Jeff Bezos sold over $13 billion worth of Amazon stock through 2024 and 2025. Mark Zuckerberg has been selling billions worth of Meta stock. Nvidia executives, even as the stock was hitting new highs, were selling shares. This is what happened in 1929 and again in 2000. Insiders know when valuations are insane and they get out before the crash. Or Warren Buffett, the most successful investor in history, is hoarding cash at levels he's never maintained before. Berkshire Hathaway's cash position exceeds $325 billion, the highest in the company's history, both in absolute terms and as a percentage of assets. Buffett has been selling stocks, including reducing his massive Apple position and buying treasury bills. When asked why, he cited valuations being too high and being unable to find attractive investments. Buffett's own metric, the Buffett indicator, which divides total stock market value by GDP, sits at 185%. He said that a reading above 120% indicates dangerous overvaluation. At 185%, the signal couldn't be clearer. The world's best investor is sitting in cash, waiting for the crash because he knows it's coming. Unemployment has started rising from the 3.4% low in early 2023 to 4.1% by October 2025. While 4.1% is still historically low, the direction of change matters more than the absolute level. The SAM rule, developed by economist Claudia Psalm, states that when the 3-month moving average of the unemployment rate rises 0.5 percentage points above its low of the prior 12 months, the economy is in recession. This rule has predicted every recession since 1970 with no false positives. As of October 2020, we're at or near the threshold that triggers the SAM rule. The unemployment trend is rising, and once it starts rising, it accelerates as layoffs trigger more layoffs. Auto loan delinquencies have spiked to levels not seen since the 2008 financial crisis. Approximately 5% of auto loans are 90 days or more past due, the highest rate since 2009. Average monthly payments on new car loans exceed $740, and loan terms have stretched to 84 months, 7 full years of payments. This is subprime lending disguised with different terminology. People who can't afford cars are being given loans they can't repay. When they default, it affects not just the lender, but their ability to get to work, creating a cascade where job loss follows auto repossession. This is a leading indicator of broader financial stress in the consumer sector. Student loan delinquency rates have surged since payments resumed in October 2023. After a 3-year pandemic pause, total student debt stands at $177 trillion across 43 million borrowers. Many are choosing to default rather than resume payments, understanding that the debt is so large they'll never pay it off anyway. This drains $100 billion or more per year from the economy as young people service debt instead of buying homes, starting families, or spending on goods and services. The generation that should be driving economic growth is instead drowning in debt that offers no economic return. Geopolitical risks in 2025 include ongoing wars in Ukraine and the Middle East, the constant threat of China invading Taiwan, and the fragmentation of global trade into rival blocs. Any of these situations could escalate into conflicts that disrupt energy supplies, food supplies, or critical supply chains. An oil price shock similar to the 1970s would trigger stagflation, the combination of inflation and recession that's even more difficult to manage than recession alone. Markets hate uncertainty, and geopolitical uncertainty in 2025 is as high as any point since the 1970s. Commercial real estate defaults are already beginning at major institutional owners. Brookfield Asset Management defaulted onto Los Angeles office towers in 2024. Blackstone, the world's largest commercial real estate owner, has struggled with redemption requests from investors wanting their money back. These are the sophisticated players, the smart money walking away from properties because the math doesn't work at current interest rates. When the major players start defaulting, it signals that the fundamentals have broken. The defaults will cascade through 2025 and 2026 as more mortgages come due, triggering bank losses, more defaults, and eventual bank failures. The crash won't announce itself with a clear starting point that everyone recognizes. It will begin with something that seems manageable: an earnings miss by a major tech company, a larger than expected regional bank failure, an escalation in a geopolitical conflict, or a breakdown in debt ceiling negotiations. The trigger itself almost doesn't matter because the system is so fragile that any shock will start the cascade. What matters is what happens next. How one failure triggers another, which triggers another until the entire financial system is in freefall. When Nvidia or another Magnificent Seven stock misses earnings projections or provides weak forward guidance, algorithmic trading systems will start selling instantly. The stock could drop 10 to 15% in a single day. Because Nvidia represents 7% of the S&P 500, that alone would take the index down 0.7%. But the real damage comes from the psychological impact. If the AI story that has driven valuations starts to crack, investors will question all tech valuations. Microsoft, Apple, Amazon, Google, Meta, and Tesla would all sell off in sympathy. Within days, the Magnificent Seven could be down 20 to 30%, taking the entire market down 6 to 9%. This triggers margin calls. Margin calls are the accelerant that turns a decline into a crash. When investors buy stocks with borrowed money and those stocks decline, the broker demands additional collateral. If the investor can't provide cash, the broker sells the stocks to cover the loan. This forced selling drives prices lower, which triggers more margin calls, which forces more selling. In 1929, margin calls created a downward spiral that couldn't be stopped. In 2025, margin debt as a percentage of market value is similar to 1929 levels. When the selling begins, it will be rapid and relentless. Institutional investors managing trillions in pension funds, endowments, and sovereign wealth funds have risk management rules that require them to sell when markets decline beyond certain thresholds. These aren't emotional decisions, they're automated processes. When stocks fall 20%, risk systems trigger selling to prevent further losses. This institutional selling adds to the downward pressure. Within the first month of the crash, stocks could easily be down 30 to 40% as retail panic selling, margin calls, and institutional risk management all drive prices lower simultaneously. The cascade moves from stocks to bonds as investors flee to what they believe is safety. But in 2025, Treasury bonds are not safe because the government needs to issue trillions more to cover deficits and refinance maturing debt. If there's a flight to safety at the same time, the government needs to sell bonds. Interest rates spike even higher. This creates a doom loop. Higher interest rates make the government's debt service costs higher, which requires more borrowing, which requires issuing more bonds, which drives rates higher. Countries caught in this doom loop typically end in either default or currency collapse through inflation. The housing market freezes as buyers disappear and sellers are unwilling to accept lower prices. Homes sit on the market for months without offers. People who need to sell for job relocations or financial reasons start cutting prices. These price cuts establish new comps that drive all home values lower. Within 6 months, home prices could be down 20 to 30% from peak. Within a year, 40 to 50% declines are realistic in overvalued markets like Austin, Phoenix, Boise, and parts of California and Florida. Homeowners who bought in the last 3 years find themselves underwater, owing more on their mortgages than their homes are worth. Commercial real estate defaults accelerate as property owners realize they can't refinance maturing mortgages. They stop making payments and hand the keys to the lender. The lender, typically a regional bank, takes possession of a property worth 40 to 60% less than the loan amount. This is called a realized loss. When banks realize massive losses on commercial real estate loans, it wipes out their capital. Banks are required to maintain minimum capital ratios. When those ratios fall below regulatory thresholds, regulators close the bank. In 2008, 465 banks failed over 5 years. In the coming crisis, we could see similar or higher numbers concentrated in a shorter period. Bank failures create panic that spreads to banks that are actually solvent. Depositors see banks failing and rush to withdraw their money from any bank they perceive as risky. This creates a classic bank run. Even healthy banks don't have enough cash on hand to pay all depositors simultaneously because they've lent the money out or invested it in securities. When a bank run starts, the bank has to sell assets to raise cash. Selling assets at fire sale prices creates losses that can turn a healthy bank insolvent. The FDI steps in to guarantee deposits, but the $125 billion insurance fund is inadequate for multiple large bank failures. The government has to print money to cover deposits, which starts the inflation process that destroys the currency. Employment collapses as companies facing declining revenues cut costs through layoffs. Tech companies that grew bloated during the boom start laying off 10 to 20% of workforces. Finance companies heavily exposed to market declines cut staff. Consumer discretionary companies facing customers who can't spend close stores and eliminate positions. Within 3 months of the crash starting, unemployment could rise from 4% to 7 or 8%. Within 6 months, 10% is realistic. Within a year, 12 to 15% unemployment is likely as the cascading failures move through the economy. The Federal Reserve faces an impossible choice. They can cut interest rates and implement quantitative easing to try to stabilize markets. But this risks reigniting inflation before it's fully been tamed. Everyone remembers 2021 to 2023 when inflation hit 9% and destroyed purchasing power. If the Fed prints trillions again, the dollar will collapse and inflation will return even worse than before. Or they can let the crash play out, which means depression-level unemployment and a decade of economic stagnation. There is no middle path. The tools that worked in 2008 don't work in 2025 because they've already been overused and everyone understands the consequences. For the average American with a 401k or IRA, watching their retirement account decline 60 to 70% will be devastating in ways that go beyond just the numbers. Someone who spent 30 years saving, who has $600,000 in their retirement account, will watch it drop to $200,000 or less. That's not a correction. That's the destruction of their financial future. They can't retire. They have to work 10 to 15 more years, assuming they can keep their job through the recession. For people already retired and depending on portfolio withdrawals to fund living expenses, the situation is even worse. They're forced to sell assets at the bottom to pay bills, locking in losses they'll never recover. The psychological impact of watching everything you've saved disappear will be profound. In 2008, retirement accounts dropped but recovered within 5.5 years. Most people who held on got back to even in the coming crash. Recovery will take much longer, if it comes at all. Japan's stock market crashed in 1990 and didn't recover to those highs until 2024, 34 years later. An entire generation of Japanese investors never recovered their wealth. The same thing could happen in America if the crash is severe enough and the recovery takes decades. Housing wealth destruction will trap millions of Americans in homes they can't afford to sell. The job market for young people entering the workforce will be brutal. College graduates in 2026 and 2027 will find no entry-level positions available. Companies won't be hiring. The jobs that do exist will have hundreds of applicants. This generation will start careers 5 to 10 years behind where they should be, suppressing their lifetime earnings. Studies of people who graduated into the 2008 recession showed they earned less over their entire careers compared to people who graduated a few years earlier. The coming crash will be worse, meaning the economic scarring will be deeper and last longer. Small businesses will be decimated as consumer spending collapses and credit becomes unavailable. The local restaurant, the small retail shop, the family-owned service business, these will fail by the hundreds of thousands. Large corporations with access to capital markets will survive, though smaller. The economy that emerges from the crash will be even more dominated by massive corporations with small businesses playing a diminished role. This reduces competition, innovation, and economic dynamism. Social safety nets will be strained beyond capacity as unemployment surges and tax revenues collapse. The government will be caught between increasing demands for services and decreasing ability to fund those services. Spending cuts will be necessary even as more people need help. This creates a humanitarian crisis on top of the economic crisis as vulnerable populations, the elderly, disabled, and unemployed face reduced support at the moment they need it most. Political instability follows economic collapse. The 1930s saw the rise of extremist movements across Europe as economic desperation made people vulnerable to authoritarian promises. Weimar Germany's hyperinflation helped create the conditions that brought Hitler to power. The United States isn't immune to the political consequences of economic catastrophe. When people lose everything, they look for someone to blame and someone who promises radical solutions. The 2025 crash will reshape American politics in ways we can't predict, but that will likely be destabilizing. So why is 2025 worse than 1929 and 2008 combined? Because we have the asset bubbles of 1929 in stocks, the debt bubbles of 2008 in housing and credit, and the government debt bubble that didn't exist in either previous crisis. All three are happening simultaneously. In 1929, only stocks crashed and only 10% of Americans were affected directly. In 2008, housing crashed, but the government could borrow to bail out banks and the Fed could print money without causing inflation. In 2025, everything is crashing together and the tools to fix it don't work anymore. The Fed can't cut rates to zero because inflation is still elevated. They can't print unlimited money because they just did that and caused the worst inflation in 40 years. The government can't bail everyone out because it's already drowning in $36 trillion of debt. The 12 warning signs I've shown you, from the inverted yield curve to Warren Buffett hoarding cash, aren't speculation, they're facts. They're happening right now. The inverted yield curve that has predicted every recession since 1950 is telling us the recession is imminent within the next 3 to 9 months. Regional banks are failing. Commercial real estate is collapsing. Consumer debt is at record highs with delinquencies rising. Unemployment is rising. Insider selling is at levels that precede crashes. Every indicator is flashing red simultaneously. The timeline is clear based on the yield curve normalizing in September 2024. Recession typically comes 3 to 12 months later. That puts us in the window of December 2025 through September 2026. Commercial mortgage refinancing peaks in 2025 and 2026. Credit card defaults are accelerating now. The trigger could come at any moment, and once it starts, the cascade will be unstoppable. This isn't prediction, this is pattern recognition. The same patterns that preceded 1929 and 2008 are present now, only more extreme. When the crash comes, stocks will drop 65 to 80% from peak, worse than 19 and 29's 89% drop because it will be faster and more concentrated. Bonds will drop 35 to 50%, something that didn't happen in previous crashes. Real estate will drop 40 to 60%, worse than 2008's decline. Unemployment will exceed 15%, and recovery will take not 5 years like 2008, but 10 to 20 years or more because the Fed has no tools left and the government has no borrowing capacity left. The everything bubble earned its name because everything crashes together and there's nowhere to hide. Those market crashes in history books, the ones we thought could never happen again because we learned from the past, are about to repeat with a violence and scale that will shock everyone who believes it can't happen. The mathematics of unpayable debt, overvalued assets and exhausted policy tools guarantee it. The crash is coming. The only question is whether you'll be prepared when it arrives.